Welcome to Investero. When it comes to investing in stocks, rich people approach the market very differently from the average investor. They don't rely on luck, hype, or speculation. Instead, they use strategies that focus on long-term growth, risk management, and building wealth steadily over time. Understanding how wealthy investors think and act can help you adopt some of the same principles in your own investing journey. The first thing rich people do is think long-term. They don't buy stocks just because the price is going up quickly or because everyone is talking about it. Instead, they look at the fundamentals of a company: revenue growth, profit margins, market share, management quality, and competitive advantages. They invest in businesses, not just in stock prices. This mindset allows them to hold on through short-term volatility because they believe in the long-term success of the company. Another important strategy is diversification. Wealthy investors don't put all their money into one stock or one sector. They spread their investments across industries like technology, healthcare, finance, energy, and consumer goods. This way, if one sector struggles, their overall portfolio remains balanced. They also diversify globally by investing not just in U.S. companies, but also in international markets, which helps reduce risk and capture growth worldwide. Rich investors also make use of dividend stocks. These are companies that pay regular cash dividends to shareholders, providing a steady stream of income regardless of market ups and downs. This income can then be reinvested to buy more shares, compounding their wealth over time. For them, dividends are like a safety net. While stock prices may fluctuate, the cash flow continues. Another way the wealthy invest in stocks is by taking advantage of tax-efficient strategies. They use accounts like retirement funds, trusts, and other vehicles to minimize taxes on capital gains and dividends. Some even borrow money at low interest rates to invest, a strategy known as leveraging, which allows them to magnify returns while still managing risk carefully. Unlike retail investors who often chase trends, wealthy people pay close attention to valuation. They look for companies trading below their intrinsic value, meaning the stock is undervalued compared to its true worth. By buying at a discount, they increase their chances of earning higher returns once the market recognizes the company's value. This is the same principle followed by legendary investors like Warren Buffett. Patience is another key factor. Rich investors don't panic when the market drops. In fact, they often see downturns as opportunities to buy great companies at cheaper prices. Instead of selling during a crash, they often increase their holdings, confident that quality businesses will recover and grow over time. Many wealthy investors also invest in index funds or exchange-traded funds alongside individual stocks. These funds track the overall market or specific sectors, giving them broad exposure while reducing the risk of picking the wrong company. It's a way to balance active investing with passive growth. Finally, rich people invest in knowledge before they invest in stocks. They read financial reports, follow global economic trends, and seek advice from professional advisors. They treat investing as a business, not a hobby. This disciplined approach helps them avoid emotional decisions and focus on long-term results. The lesson here is clear. Wealthy investors succeed in the stock market because they prioritize fundamentals: diversification, patience, and strategy over quick profits. They think like owners of businesses, not gamblers chasing short-term gains. By adopting even a few of these principles, such as focusing on value, reinvesting dividends, and staying patient, you can begin to build wealth the same way rich people do. Subscribe to Invest.